Beginner's Guide for Forex Traders. Forex trading, also known as foreign exchange, is indeed a lucrative venture, yet, like every other trade, it has its own risks and challenges. Forex trading involves buying and selling currencies against one another to profit from fluctuations in exchange rates. It can be highly profitable but also risky, so it's important to approach it with a clear understanding. It is safer to study and understand the dynamics of the Forex market before venturing into it. Here's a structured guide to get you started. Understanding Forex Basics. Forex Market. The Forex market is the largest financial market in the world, with over $6 trillion traded daily. It operates 24 hours a day, 5 days a week, and includes banks, financial institutions, corporations, and individual traders. Currency pairs. Currencies are traded in pairs, e.g., euro to US dollar, pound sterling to US dollar, with the first currency being the base currency and the second being the quote currency. Example, euro to US dollar means you are buying euros and selling US dollars. Pip. A pip is the smallest price move in a currency pair, typically representing 0.0001 for most pairs. Leverage. Forex brokers often offer leverage, allowing traders to control larger positions with a smaller amount of capital. Example, a leverage of 100:1 means you can control $100,000 with just $1,000. However, leverage magnifies both potential profits and losses. Choosing a Forex broker. When selecting a broker, consider these factors. Regulation. Make sure the broker is regulated by recognized authorities, e.g., FCA, NFA. Trading platform. Most brokers offer platforms like MetaTrader 4, MT4, or MetaTrader 5, MT5, which are user-friendly and feature-rich. Spreads and fees. Brokers may offer fixed or variable spreads. Lower spreads can mean lower costs for your trades. Customer support. Good customer service can help resolve issues quickly. Key Forex terms. Lot. A standard unit of trade. A standard lot equals 100,000 units of the base currency. Margin. The amount of capital required to open a leveraged position. Stop loss. In order to close a position once a certain loss level is reached, helping to limit losses. Take profit, in order to close a position once a specific profit level is reached. Bid/ask price. The bid is the price at which you can sell, and the ask is the price at which you can buy a currency pair. Basic Forex trading strategies. The trends. This strategy involves identifying a trend and trading in the direction of that trend. You buy during an uptrend and sell during a downtrend. Range trading. When the market is not trending, you buy at support levels, low points, and sell at resistance levels, high points. Breakout trading. This strategy involves entering a trade when the price breaks out of a defined range or level of support or resistance. Common indicators. Moving averages. These help smooth price data to identify trends. RSI, Relative Strength Index, measures the strength of a currency pair, showing whether it's overbought or oversold. MACD, Moving Average Convergence Divergence, a trend-following momentum indicator that helps identify trend reversals. Bollinger Bands, show the volatility of a currency pair and can indicate overbought or oversold conditions. Risk Management. Position sizing, only risk a small percentage, 1 to 2%, of your trading capital per trade. This protects your account from large losses. Stop loss orders. Always use stop loss orders to limit your potential losses on any trade. Risk to reward ratio. Aim for a favorable risk to reward ratio, e.g., risking $1 to potentially make $2. Developing a trading plan. A trading plan should outline your goals. Define what you aim to achieve with trading, e.g., earning a certain percentage return. Risk tolerance. Determine how much of your account you're willing to risk per trade. Trading schedule. Decide how much time you can dedicate to trading. Strategy. Define the strategies you'll use to enter and exit trades. Review. Regularly evaluate your trades and adjust your strategy as necessary. Demo trading and backtesting. Before committing real money, practice on a demo account. This helps you understand how the platform works, test strategies, and get used to the market dynamics without risking real capital. Backtesting. Test your trading strategy using historical data to see how it would have performed in the past. This is useful for refining strategies. The art of Forex trading. Successful trading isn't just about strategy, but also about psychology. Emotions. Avoid emotional trading decisions based on fear or greed. Discipline. Stick to your trading plan and avoid impulsive decisions. Patience. Wait for the right opportunities and don't chase the market. Learning and improving. Education. Continuously improve your knowledge by reading books, attending webinars, and learning from experienced traders. Journaling. Keep a trading journal to track your trades, strategies, and emotions. This helps identify patterns and areas for improvement. Common mistakes to avoid. Over-leveraging. Using excessive leverage can quickly deplete your trading account. Lack of preparation. Entering trades without a plan or understanding the market. Chasing losses. Trying to recover from a loss by increasing trade size or taking riskier positions. Ignoring risk management. Neglecting stop-loss orders or proper position sizing can lead to significant losses. Important notice. By starting with a solid understanding of these basics, you can begin trading in the Forex market with more confidence. Keep in mind that success in Forex trading requires continuous learning and experience, so take your time to practice and improve your skills.